Welcome to the State of the Markets podcast. I'm Paul Rodriguez of ThinkTrading.com.
I'm Tim Price of PriceValuePartners.com.
And our very special returning guest is Dave Hunter. So, Dave Hunter, welcome back to the show.
Yeah, thank you. Thanks for having me on again.
Yeah, it's always a pleasure to have you on. And it's also good to look back at when you were last on and what you were saying. And you first came on the pod in February 2024, and you were talking about a melt up, which nobody else was saying. You were talking about gold and silver accelerating higher. And then you came on again in February this year as things had gone up. But gold and silver was just still consolidating, but you were firmly of the camp that things were really going to take off. To quote you, you said that you're extremely bullish in this final leg, and the market will frustrate, which we'll come back to because we got the tariff correction that came straight after that. You were looking for a correction, perhaps not as big as the one that we saw, but
yeah, definitely not.
Oh, but the main point is, I know that you update on your Twitter, and you got over 220,000 followers, and you were saying that the bull market is not over. So those were all amazing calls up to then, and you've still made some more. So are we in the phase of the melt up proper right now? Do you think this is it, or are we turning down?
Yeah, I think you can pretty much date the melt up. As I say, we had a melt up in 2021. So this is a separate melt up, because I get accused of, oh, you've been saying melt up forever. I said, we've had two melt ups. And the second one, I think, really started in April when we had that big sell off. From that bottom, I think we've been in a melt up.
Right, absolutely. And when you see the market coming off, it's like you're waiting for a big storm, and we get like a few bolts of lightning and some thunder and some heavy rain, and everybody's like, right, that's it, the bull market's over. But you're the ultimate contrarian. You seem to know exactly when to stay with the course, and you haven't called the top yet. So perhaps you have now. Maybe you're saying that now. Let's get your current view. But what keeps you in the bull market, and what keeps you from switching your view to the downside?
Yeah, as you say, I am a contrarian, and probably the contrarian out there. And so sentiment does factor big in my work. So in April, when we had the 20% sell-off, you heard every strategist, almost every market analyst on the street, lower numbers, turn very bearish, say the top's in. That was music to my ears. I said, we're looking at sentiment at the bottom, back under 5,000. We're looking at sentiment not that dissimilar from 2020 at the bottom. So amazingly, we went from, because that's all it was, a few days, but it happened so violently that people got very negative. And of course, as I've said for a long time, institutions have had one foot out the door the whole way up from the October 2022 low. So all they need is an excuse in terms of the market rolling over to get bearish and get nervous. So I saw such negative sentiment down under 5,000 that I actually raised targets while everybody else was lowering targets.
Wow.
I think my target then was 8,000, and I raised it to 8,700 on the S&P. And I've since raised it again in my recent fourth quarter letter, back in early October. But it is sentiment that kind of drives it. I do look for sure at the fundamentals. I can't ignore fundamentals or technicals or what have you. But sentiment is certainly an important factor.
Tim, I will hog the mic unless you jump in. So you go for it.
David, you've mentioned technicals and fundamentals. Now, it's something you've preempted a question I was going to ask, which is, of all the different inputs to an output in terms of a view of the market, where do they rank? How do you prioritize these things?
Yeah, I don't really rank them. What I say is it's the sum of my analysis. So it is technicals, it is fundamentals, it is macro. Obviously, I'm a big macro person. Um, it is the sentiment. And the one other kind of wrinkle that I'm not sure everybody does, or I don't think a lot of people do, is because I was portfolio manager, I always looked at cross markets. And, if one thing confirms another, it gives me more confidence. So I look at various sector work and, even individual stocks like NVIDIA are so important. I'll look at all of that. And if that also is pointing in the same direction as my technicals, as my fundamentals, as my macro, then that's just going to give me a lot more confidence. And part of the reason for raising numbers again in October so quickly after, I raised them in April was because I looked at my sector work and I said, these things have a lot more upside. I don't think I'm giving the indexes enough upside to match what I'm seeing in some of the indexes, in some of the sectors. So that's how I kind of put it all together. And it's not, at any one point in time, one thing may be more of a factor than another. But ultimately, as I say, these markets are not one factor markets. Retail investors tend to want simple one factor. Is if rates are going down, is that why you're bullish or whatever? I need a lot of things, or I look at a lot of things, and it's when all those things kind of are rowing in the same direction, it gives me a lot of conviction.
So notwithstanding what you've said about one factor investing, to use a somewhat artificial premise and say someone would have burst in here now and hold a gun to your head and say, I need advice for my child who's going to go to university and then work in finance. Assuming they were going to go to university at all, which is a separate question, what subject would you advise or recommend that they study if they wanted a background in finance? Because the options for me, again, in the somewhat artificial paradigm, would be any one of economics, brackets, no, brackets, history and psychology. What advice would you give someone who was looking for that kind of input?
Yeah, if they're looking to get into investing, I mean, if they're looking to be a money manager or um, you know something along those lines, I think you really need history. You really need, certainly finance would be at the top of the list. You need economics, and you need probably those three would be the biggest ones. But it's not like you can choose one. Obviously, finance is probably at the top of the list. But it's funny, when I was in school, economics had kind of lost its luster, and it was hard. If you were an economics major, it was hard to get a job as an economist. Now, economists are all over the place, and it is an important factor. Unfortunately, most economists don't have a great track record in terms of forecasting. So I'd say if you're going to be an economics major, um, do it well, study hard.
I mean, I was with a client at lunch, and the supposition I made was that the crowning irony of the financial services industry is that most of the people within it have no understanding of even how money is created by banks. Would you concur with that?
Yes, I would, and taking it beyond just our profession, or those that are informed and do this somewhat in their line of work. I'd say all the way across, particularly for my country, but I'm sure it holds true over there. Um, what we don't do a good job of is teaching any economics at all in the lower education period, in high school or middle school, and as a result, it affects how people vote. They're basically ignorant of what they should be voting for. Just like we saw in New York City this week, is they're voting for a devout communist because he promises free this and free that, and they're voting because they're unhappy with the cost of living. They're unhappy with their not being able to afford homes or even be able to afford their rent.
But they're voting for economic
And
suicide.
so, yeah, but it is economic suicide, and it's because they don't understand how the economy works. And frankly, neither do an awful lot of people in our business.
Yeah.
So, it's a sad thing that I think that has been a benefit to me as I learned pretty early on what did matter in economics.
Yeah, there's. I remember when I worked for a major investment bank in the '90s, and the guy I was on the research desk with, he would get very angry with the salespeople who didn't really understand what was going on in the markets. The traders do, but the salespeople, and to be fair, there's some very clever clients out there, and some that aren't so much. But my point was, well, if they knew everything and if the economists were right, then they wouldn't need analysts like us. So that kind of, sometimes it is extremely frustrating though to see what the powers that be are doing. You know, the people who should really know. And in regard to that, what do you think of the political situation with regards to what shouldn't be political, the way the Fed are acting with Trump? How do you see that playing out? I think they've just moved to a QE from a QT. Is that playing into your, well, it's clearly playing into your strategy. Did you expect that? Do you think there's more politics to come?
Yeah, I did expect that. I think they're doing the right thing. I mean, I've been pretty vocal over the last year or more saying the Fed is behind the curve. They're overly worried about inflation, and so is Wall Street, frankly. I think the risk is really deflation here. And so, yeah, I think they were shrinking the balance sheet. Rightfully, they're concerned about what happened in 20 and 2021 in terms of the big expansion. You know, the Fed's balance sheet expanded by $5 trillion. You know, never saw anything like that before, but we panicked in a pandemic. Saw similar, obviously, in the ECB and elsewhere. So, you know, I get that Jay Powell is concerned about, you know, let's get this back to a more normalized balance sheet. The problem is a lot of that money is gone. I mean, it was, you know, it's not like that $5 trillion is just sitting in the Fed waiting to be pulled back out. So you do have in the shorter run the fact that you know, we expanded the balance sheet to $9 trillion and now have shrunk it down to 6.5 or below. And in the short run, that's a lot of money to pull out of the system. So I think they're hopefully in the nick of time. Basically, said we're not doing further QT because the banking system is getting tighter. The question now is, because there are leads and lags to this, are we going to find that they went too far? And my personal opinion is they went too far, and that sometime next year we're going to suffer the consequences. They haven't gone to QE. They've gone from QT to neutral.
Okay.
They're not looking to expand yet. I think over the next 6 months you will see that they are not only having to cut rates but also begin to do QE. And what I have said, which is not your question, but what I have said for quite a while, is that the global bust that I'm predicting, part of it is the result of the fact that they don't want to go back to the zero interest rate policies of the last decade and before, the last 15 years. And Jay Powell said that vocally, that he's not. He does not want to go back to ZIRP policy. He doesn't want to go back to where they print money like crazy and bail out Wall Street or bail out the markets. So if things start unraveling because they've been too tight, because the cycle is coming to an end, they're going to be slow to respond. And because we have more leverage by far than we even had in 2008-9, because we have more leverage and not just in the U.S. but around the world, far beyond anything we've ever had in history, it's a bad time to be, very tepid in terms of your response. Because what happens is leverage works great on the way up, helps enhance returns, helps enhance economies. On the way down, it's devastating, and you can't. If you are slow, that slowness will be responded to in a big way on the downside.
Some people are saying that this is a political thing, and they're just trying to stop the economy looking good for Trump. They're actually trying to slow it down, and Jay Powell is using every excuse not to cut rates. He said inflation, when it gets down to a certain level, he'll cut rates. It got down to that level, and it was like, well, forward expectations of inflation are still too high. And it could be that they just are doing everything they can to get Trump out next time, or just to make his policies not work. Do you think, I guess it's academic in the market term, but do you think there's anything in that at all?
I've been pretty, it's funny because I think ultimately the Fed's going to make a big policy mistake and may have already started that by being too slow to, by being too tight for too long. I have been pretty a defender of Jay Powell in terms of saying I can understand his rationale. I don't think it's political. I think he is looking at the past cycle and saying we don't want to repeat that. He is also understanding that if you let the inflation genie back out of the, having brought inflation down from 9% down to 3 or below 2.5, if you ease too soon and you let the genie back out of the bottle, it's a lot harder job to bring it back in. And so he's being, somewhat, he's certainly erred on the side of let's stay more restrictive because we don't want that to happen. Um, and the economy has been, even for me, surprisingly resilient. So there's been, we just had a 3.8% GDP print last quarter. And so far this quarter, I think they're still expecting, something closer to 3. So that may be wrong. I mean, as we move through the quarter, that may, although we're, at least a third of the way through it, that may slow. But I can't fault the Fed for having, basically, if you look, they've brought inflation down without hurting the economy in a big way and without hurting the markets. How can you say his policies have been wrong up to date? I get where Trump's coming from in terms of looking forward. I think rates do have to come down. You're hurting housing. Home built buyers are walking away because they can't afford the mortgage payments, et cetera. And housing is a big part of our economy. So I get where Trump's coming from, and he certainly has a background in real estate. But I also get where Powell's coming from, and the answer to that standoff is not known yet. We can all speculate, but Powell may be the one that gets the last laugh in terms of saying, "See, I did the right thing." I personally think we're at that point where we're going to start really seeing some deterioration, and the Fed's going to have to step up and start easing more aggressively. But that's still a guess, as we don't know that yet.
To what extent do you think that the movements that we've seen in the last year or couple of years in real assets, precious metals, and particularly commodities generally, are reflecting a generalized loss of faith in the whole fiat system?
That was exactly the question I was going to ask, but I'm just going to add that when you were last on, you were looking for 3,400 in gold, $75 in silver, and you were looking for $6 a pound in copper, which was a great call because it hit that bang on. So I was going to ask the inflationary question in with that, but I just wanted to put those numbers in there because those were your calls.
Yeah. So to preface, I have raised targets. My gold target I had raised to 34, from 34 to 4,000. In my October letter, I raised it to 5,000. So that was beginning of October. My silver target has been 75 for quite a while. In October, I hiked that up to 100. And my copper target a while back, I can't remember whether it was my July letter or before, probably July. I hiked that to $7, and it soon thereafter, whenever I did hike it, like probably a week after or within a short time, Trump announced the tariffs on the refining copper refining, and it went from $6 down to $4.50 or wherever. I stuck with the 7. I said, I just don't know yet. My convictions are a little lower on copper now because of that, but because I still saw a long run in the metals, I said I'm going to stick with my 7, and I think I'm glad I did. I still think that's probably a good number for the end of this cycle.
So it got hoovered up quite quickly, though, didn't it? So that's a positive. It got hoovered up. It
came back. I mean, we're back. We're back over 5. So
yeah.
I think you're going to have a run in all the material prices here in the next 3 months. So, and then the question that Tim asked, refresh my memory.
So he,
Yeah, to what extent does the rally in precious metals, real assets, commodities reflect a generalized loss of faith in fiat?
Yeah. I think certainly that's a part of it. It reflects, I think, the reality that the BRICS are trying to put together their own currency of sorts, or certainly a trading cartel where they're going to have gold backed currency there of some sort. Or so I think it reflects that, and kind of as a corollary to that, it reflects the concern that things like the dollar and the euro don't have anything backing it, and we've had a history of printing our way out of everything. So I think that's there. I also think, though, it is technical in that a lot of, as you guys well know, a lot of what happens in markets is the momentum, and I call the momentum of the tape. And certainly gold and silver have broken many technical resistance areas, and in gold cases at all-time highs, and silver just got to new all-time highs. I think a lot of this is just like in any stock or any sector, as it gains momentum, it begets more momentum. And people give you any rationale they want, but why are they buying it? If gold were $2,000 and we had the exact same scenario out here, it wouldn't be running like this. If silver were $30 instead of 48 or $9, it wouldn't be running like this, because people still wouldn't be on board because the momentum wasn't there. So I think a lot of it is as much that. And frankly, an important piece here is that with all this big run, I mean, gold's run from, 1620 back 5 years ago, I think, or maybe it was less than that, to 4,400. Silver's run from high teens to 50. And yet institutions are really not on board yet. They're just beginning to start accumulating. They're just beginning on gold to say, yeah, we do need gold. You're hearing some talk of people saying allocate 10 or 20% to an institutional portfolio. And silver is, I think, still not there at all in terms of something the institutions are strongly looking at. So that tells you you've still got all that buying to come. And I'll tell you, these are, particularly in the miners, but these are thin areas when you start seeing institutions trying to accumulate. So it tells me there's a long runway still ahead. Maybe a fast runway, just like in 2011 when these things went vertical. That's kind of what I expect the next 3 to 6 months to look like. And a lot of that will come from the institutions saying, we got to have a piece of this.
For me, the logical next question is, how do you feel about tech and AI related stocks?
I think they still have plenty of legs. I don't have the numbers in my head for now, or I haven't done a recent calculation, but my targets for the S&P is 9,500 now. My target for the Nasdaq was raised a couple times, but in most recent raise was from 30,000 to 32,000. And I have the Dow was raised from 60,000 to 65,000. The Russell from 3,400 to 3,800. And those are my October raises, and I had raised back in April, at least for a couple of them, S&P and the Nasdaq. If you do the calculations, I think you'd find now the S&P, my number from current price to that top, is a little bit, maybe a little bit more than even the Nasdaq. All along, the Nasdaq's been my, the one I expected to outpace. They're still both going up, close to 40%. One over 40, another under 40. My Russell target, I think, is still 50% plus away. And my Dow target's probably mid 30s to 40, somewhere just under Nasdaq probably. So I'm going through that just to say the Nasdaq is obviously the tech index of all of them. And so I'm starting to basically, if you look at my numbers, expect it to maybe slightly tail off, but I still have, SMH, the semiconductor index, another almost 40% to go from here, in spite of the fact that it's more than doubled since, I think it's up 118% since April. So I have a 500 target on SMH. So again, that's pretty much in line with the NASDAQ, a little bit under, certainly under the Russell and under. So I think they will still play and still play big, and AI too, in terms of the big AI players and the Mag 7. I think they will continue to be leaders, just not quite the outpacers that they were before. In fact, probably more in line with the other indexes. But you're hearing a lot of people trying to make the case that they've topped, or that they're up in the stratosphere and it's time to sell. I think it's premature.
Well, the Bank of England, I don't know if you know, they issued, not that you would because of where you are, but they mentioned that they thought
that anyone should listen to the Bank of England anyway.
Exactly. They said that AI was in a bubble and to watch out. And I thought, well, that's a green light. And Nvidia broke into new all-time highs, at AMD into all-time highs. NASDAQ is still performing very well. And I know we've had a bit of a wobble recently in the markets, a little pullback, but that you don't get that sort of call at the top of the market. They don't ring a bell like that.
Exactly. Yeah. The fact that everybody's saying bubble is a good reason why it's not a bubble yet.
I just wondered whether you thought that because the market has bounced back so powerfully from every single correction, when we eventually get that final melt, I know we're part of the melt up, but the parabolic move from the melt up, whether that will be why people think in the first phase when it comes down that there'll be lots of buying, and that will be the difference between what we're seeing now. In other words, people will start to say, oh yeah, well, it always goes up, doesn't it? And they'll start listing all the times the market pulled back and then recovered, and they'll use that as the excuse that they should buy it at that point. But that will be once it's hit the absolute high.
Yeah, I think, as I say, I think the narrative at the top is going to be, we have the wind at our back because the Fed and the central banks are easing. That this is the beginning of a Fed easing cycle that can last for a year or two. So you've got another year or two in the stock market to go. So they're going to be, whereas the rhetoric all along here has been, this thing could top any day or any week or any month. I think they're going to be back to, we have a long runway and we still have a couple of years to run. That's what I expect to hear at the top. And the institutions that have been with one foot out the door are going to be the ones telling you, no, this thing's not near a top yet. And then once it rolls over, I don't know whether we'll see like a fast 10% and they'll come back in there, or whether once we roll, because this has been such a long bull market, the first step down might be 20 or 30%. I don't know that, but I do think, as I tell people all the time, because they'll say, how will you know when the top is here? I said, I won't obviously be able to precisely call top, but the things I'm looking for is when everybody's all in. Right now, everybody's far from all in. The minute you get a 2% sell-off, they're back to saying the top's in, or, things are, getting close to the end. When you start hearing everybody saying there's a long runway ahead, which is what I've said all along, when they start saying that, and I'm probably going the other way.
Yeah, absolutely. So there must be more people now that are starting to jump on the Dave Hunter bandwagon and using the term melt up, but not enough to indicate it's the top. And
do you have an ETF yet, Dave?
Yeah, that's right. I started using melt up, I think probably in certainly 2020. I may have used it in 2019. And nobody was using it, or very few. There may have been a couple of people that used that term. And I used bust back then, and nobody was using bust. So now you're seeing those terms thrown around a lot. And I go, I didn't invent the terms, but I was using them in terms of Wall Street parlance way before anybody else. And now a lot of people use melt up for every rally practically, and that's not what a melt up is in my book anyway. But yeah, you are seeing certainly a lot more bullishness out there. It's interesting. Somebody on Twitter talked today about the investors' intelligence numbers, and I hadn't seen anybody use that talk about that service in a long time. I used to follow that a lot when I was an institutional money manager. But if I remember right, that one is a survey of letter writers, basically money market analysts. So it's not money managers; it's people with an opinion, like me, strategists, and doing surveys of that every month. And it was showing very high bullishness, pretty historically high bullishness. And that contradicts, if you look at the CNN fear greed index, that shows extreme fear. And if you look at Bank of America's survey of portfolio managers, that shows that they're very cautious or still haven't gotten on board in a big way. And so it confuses people. But I think letter writers have definitely kind of joined my chorus, but they aren't the ones that are basically investing. And I think that is still why, that's why I certainly think there's still a long runway. Is that retail certainly more bullish, but the institutions are, doesn't mean they're not in the market because they have to be, but they're defensively postured still, or they turn negative at the first sign of a sell-off. That's a sign of a market that basically still has a wall of worry to climb. Still has that fuel ahead of it.
It reminded me of the three stages of truth. First of all, the argument is laughable or ignored. And then secondly, it's violently opposed. And then the third one, which is what I guess we're waiting for, it's accepted as being self-evident. Oh, yeah, of course it was going to melt up. Of course it.
Yeah, right.
And it was obvious all the time. And
right.
This is why I go back to your calls from before, because when we're sitting here now with the market as high as it is, with everything that's happened in between, even talking about the acceleration in silver, which we talked about last time, and how it could go towards $50 really very quickly. It had done it before, but gold had made an all-time high. Silver hadn't. Your call on silver was exceptional as it was accelerating higher. And I was also looking at palladium and platinum at that time when we talked about that, which at that time you said that they weren't part of the markets that you look at. And I just wondered, given that they've started to move, would they now be part of your portfolio? Would you be interested in them, or are you just sticking with silver?
Yeah, I don't follow them and don't plan to follow them, but basically they trade with the other precious metals typically. Palladium, they have some other industrial uses and things that I don't pay a lot of attention to, so I just soon, I just decided I'm not following, at least not this cycle.
Yeah.
But generally they're going to probably trade up when silver and gold trade up too.
Yeah.
Certainly platinum will.
Yeah.
And palladium's got a little different dynamic, but generally trades with them.
With regard to oil, and oil was one of your other outstanding calls where you said that you thought that it would go down, even though you were really bullish on commodities, which would be extremely unusual for it to move counter to the rest of the market, especially with the dollar going down, especially with gold going down. It's just like a really unusual call. I just wondered whether there may be more reason for that happening now that we've seen the proliferation of, or the number of electric vehicles out there has gone up, which has been putting pressure on the UK government to perhaps put tax on electric vehicles, which was a rumor that's been going around in the UK press for our upcoming budget. So
that's an interesting one, because the US obviously has been subsidizing the EV market, and I personally don't think this has almost anything to do with electric vehicles. It is a supply demand thing, but electric vehicles still represent, at least over here, a very small fraction of automobiles, and is not having much of an impact, I don't think, on energy. So I think it's more that we are awash with oil around the world at this point, and that the economies around the world are not doing well. And I even talk about the U.S. Yes, we had a 3.8% GDP number, but under the surface, statistically, everything looks okay. Under the surface, our economy's not doing that well. So I really think it's more a sign that, it's kind of, we're leading to a bust. We're in a period now where you can still make the argument that you got the best of both worlds, inflation coming down or trending down and the economy trending up. But under the surface, I think really half the economy is not doing well. And so demand for oil is not as strong as it would otherwise be. And I think you can pretty much extrapolate that across the world. And probably the biggest story is really the supply of oil. We really have a strong excess of oil supply over demand, and so price comes down. And that's been my case. Why I was bearish on oil from 120 or 130 down. I missed the spike when Russia invaded Ukraine. We were at 85, and I certainly didn't expect over 100. And so I missed that 1 week spike or one few week spike. But I remained of the opinion that oil was supply exceeded demand and would continue to do that in this cycle. And I had a $60 number. Once we got back below 100, I had when it was in the 120s, I said 85. We'd go back there. Then once we started getting closer to that, under 100, I lowered my number to 60 or mid 60s anyway, and I've stuck with that all the way through. And you're right, compared to everything else where I was bullish on materials and on most commodities, oil was kind of the outlier that nobody understood why I was so bearish, and I was pretty much the only bear on oil for quite a while.
Especially with what's happened in the Middle East, and as you say, the geopolitical tension that's been going on. It's almost like, hang on a minute, how is oil not going up? Gold's going up, and it's been the reasons for that have been discussed at length. But oil would normally be rising in that environment, and the fact that it didn't, it was definitely a signal that something was wrong in that market. And is your target $30 now?
Yeah, it's been 30 in the bust. When the bust hits, I've been saying 30 for several years now, that's where we would ultimately head. My target of 60 was pre-bust, and obviously we went to 55 on WTI. So I wouldn't be surprised if we kind of bounce around between the low 50s and the mid to high 60s for the balance, for the next 6 months. But I think once the bust hits, demand's going to fall through the floor, and you'll still have excess supply. So I think you can get down, and 30 may not be low enough, but I'll use 30, because somewhere down there.
Yeah, because you categorize everything in pre-bust and post-bust, don't you?
Right. Yeah. Pre-bust, bust, and post-bust. Just because, as I say, the bust is like standing on the south rim of the Grand Canyon and looking across the north rim and not recognizing that there's this big canyon in between. The bust is that canyon that can impact. It's going to impact the markets big time. I'm calling for an 80% bear market. No, could it be 70 instead of 80? Sure. Could it be 65 instead of 80? Yeah, I generally think 70, 80 is pretty likely. And oil can go to 30. Gold and silver will get hit hard. I think silver much harder than gold. So it's pretty much across the board. As I say, the only thing that will probably stand up, or one of the few things that will stand up in the bust, will be treasuries. People will run to the treasury market to protect their capital.
And this is what you've said before, short-term treasuries as opposed to the long end, because of course.
No, I've been very, very clear that it's across the treasury curve.
Okay.
I'm opposite of almost everybody out there who's worried about the long rates going up. I have a 10-year going to zero. I have the 30-year going to somewhere between a quarter and a half.
And
in
just
the
to clarify,
bust.
you're talking about yields and not prices.
Yes, those are yields.
Yeah.
I get people get confused and say, you're talking about it going lower, bonds are going lower. I said, no, yields are going lower.
Ah,
Bonds will be going up.
right. But to be fair, that is post bust, right? That has to be
No, that is in the bust.
that's in the bust.
So
Oh
if
yeah,
you
and
if
then
you
post.
think about it, when all hell is breaking loose and um, everything's hitting the fan, you will have people running. It may not start this way because the U.S. is still, foreigners are still a little bit nervous about, maybe more than a little bit nervous about the U.S. fiscal situation. But when all hell breaks loose in every down cycle we ever have, ultimately people run to the dollar, and foreigners run to the dollar, and people both U.S. and foreign run to treasuries because it's we may not be what we used to be, but we're still the cleanest shirt in a dirty bag. So people will say, if there's anywhere I can feel at least somewhat safe, it's U.S. treasuries. So that it will, and then you take it from that. You also take it from the standpoint of banks, as short rates go to zero and maybe even negative. Banks are going to say, well, we can't lend money out because credits are really deteriorating. We're going to be very careful about who we lend to. We got to put our money somewhere. We're not earning any money on short rates. We can at least earn something on 10-year and out. And so that's why they'll be buying everything. And then most importantly, the Fed will be buying every bond in sight, because I predict, and again, this is a seat of the pants guess, but I predict, whereas we printed 5 trillion in 2021, I predict we'll do 4 times that this time, so 20 trillion. And I might be low, I don't know, but it's going to be a massive amount of money, because they're going to start slow and things are going to roll downhill fast, and this is worldwide. It's going to take a big central bank um, effort to stabilize a free falling banking system around the world. So look at 2008-9 and just know this is probably going to be worse.
This reminds me of an anecdote I had with a client back in 08, 09. And we went up to the north of England to chat with this guy. And we went to try and suggest there's value in a sovereign bond fund that had immaculate credit research, that had a yield, I think at the time, of 8%, that you could have hedged into Singapore dollars if you wanted that, for example. And it was a multi sort of sovereign fund. And he said, "Well, thank you very much, but I'm putting my." He predicted a decade-long deflationary depression, and as a result of that, he was positioned in long-dated U.S. Treasury bonds, U.S. dated U.K. government bonds, long-dated German paper, and a large amount of gold. And I couldn't really fault his thinking, but I did have to challenge him on the US bond front. I said, well, why would you own US bonds yielding perhaps, I think at the time, 4%, when you can own an objectively superior credit fund, diversified, yielding 8%? And his answer was very intriguing. He said, because they've got all the nukes. And that was a level of thinking that I hadn't really taken into consideration at the time.
Yeah,
And that was a
my
level of sort of
reasoning is,
second order thinking that I hadn't really borne in mind,
yes,
that when push comes to shove, certain things trump even economic issues.
yeah, I doubt. My reasoning is more the printing press. The U.S. has the ability, if in fact I'm right, we're heading for deflation. That the bust will cause us, because we're at somewhere between 2 and 3% inflation now. When demand falls through the floor and the economy around the world is free falling, you're going to see inflation into negative territory. So if you're in deflation during the bust, that means the Federal Reserve, and frankly all the central banks, will have almost infinite ability to print money. That's why I don't worry about the sovereigns this time around, or certainly not the U.S. Some sovereigns may be a problem, but they'll have infinite money to basically print money. And what's printing money? Printing money is the Fed buying treasuries. So they'll be looking for every treasury they can get their hands on and putting money into the system. Next cycle, If you skip out a decade, I think it's a whole different story. We'll be in hyperinflation, and the printing press will be shut down, and we'll have no ability to really service our debt. You know, the cost, the interest cost alone, will be beyond the amount of money we take in. So we won't have money for Social Security. We won't have money for welfare program. We won't have money for unemployment. We won't have money for military, and we probably won't have enough money to even service the debt. And it's at that point, you know, again, it's out in the mid 2030s, I think. When you take the printing press away, you find out that the last 80 years, and certainly the last 50 years, has been one big Ponzi scheme.
But my argument would be that the next time we get close to Fed QE, the average investor will realize that the nature of the Ponzi scheme, and it's more likely that the likes of gold and silver would go moon rocket than treasuries. Because it's what Mises called the crack up boom, where you get a rally in basically, or a flight to safety or a flight to reality in every form of real asset, and a flight away from paper full stop.
Yeah, that will take place initially. You know, let's say 2026 is the bust and the bear market. So let's say this, I'm right, and the stock market drops 80%. Let's use 10,000 for easy numbers. If it drops 80%, that takes you down to 2,000, right? From 10,000 to 2,000. I believe, and the bottom might be the end, you know, the fourth quarter of next year, so a year from now. And I believe from that 2,000 on the S&P, you could even triple or quadruple, because they're going to print $20 trillion. And that money's going to fall, you know, go into the capital markets in a big way. You could even triple off the bottom, or even quadruple off the bottom. So that takes you to 6,000 or 8,000. If the top is 9,500 or 10,000, that's still far short of this cycle's top, right? So we're making a secular peak this cycle, in my opinion. But that doesn't mean you won't have a cyclical bull market coming out of there. It might last 2 years. So let's say it's, you know, by the end of 2028, maybe even in 2027, you top out on the indexes. And from there, gold and silver will go merrily higher, probably many times higher, while the stock market begins to trade flat and then down.
I guess
so for a couple of years coming out of the bust, a lot of things will work because there's a lot of money out there. But as you move, you know, a year or two away from the bust, then your thesis is correct that the only things that will work will be the things that can keep up with inflation.
My concern would be that it's more of an existential concern, that the nature of the leverage embedded in the system, and there's so much credit in the system, that the financial markets in their current form could not survive an 80% drawdown in stocks, say.
They'll survive for one reason, and that's the printing press. If you print, I mean, I think we throw.
But there's
out
a difference
numbers.
between notional and real, then, or nominal and real, because that sounds to me like the danger of a sort of Weimar 23 era hyperinflation, where you can sort of keep your money broadly. The purchasing power is protected by being in stocks, but the reality is that the entire society is decimated, and that leads to a world war.
Yeah, yes, you're right. I'm just telling you it's going to play out over a longer period than you think. You know, our minds can go to the understanding of what's coming much faster than it plays out. So that's all I'm saying is, as I say, my forecasts are not endorsements. I'm not endorsing all this money being printed. I'm not endorsing what's coming. I'm just telling you how it likely will play out. I'm not going to have it anywhere near precise, but I think and keep in mind, if I talk 20 trillion out of the Fed, it's probably 50 trillion around the world out of all the central banks, because everybody's doing the same thing. We're going to be in the same boat. So this is worldwide. It's going to take, it might all play out very quickly, meaning you might go bottom to top in the stock market before you flatten out in 12 to 18 months. I'm guessing it's more like 18 months, but something like that. So, and it's going to take, because of leads and lags from when money translates into inflation, it's going to take at least 12 to 18 months, because that's a normal 18 months is normal lag with money. But if it's this much money, maybe it comes faster. But you're coming out of deflation. So the first year out of deflation, maybe you'll have, a couple of percent or 3% inflation. The second year, you might be up into, middle to high single digit. The third year out, you're in double digit. And the fourth year out, I'm predicting inflation in the US will ultimately, by the early 2030s, be up around 25%. Now, that's why I say, and rates will track that. So if inflation goes to 20 or 25%, interest rates are going to go to 15, 20, maybe a little higher on short rates. Long rates will go up towards 20. How do you solve that equation when you've got currently 38 trillion in U.S. debt and a lot more than that in overall debt, 330 trillion in debt around the world? Nobody's going to be able to afford the servicing of that debt. So if
I don't think the system survives that. So that there's going to be a monetary reset of sorts coming. We just don't know in what form it's going to arrive.
Well, my forecast, and I've talked about this over several years, is that we have a collapse of the worldwide system by somewhere between, and again, I could be off by 3, 4, 5 years, who knows? But my best guess right now is somewhere between 2033 and 2035. We have a complete collapse of the Ponzi scheme, a complete collapse of the system, so that the system we have now is gone. You can throw in there World War, because who knows? I don't disagree that often comes when we're in this kind of situation. But that's where I think this is heading. And that's why I say we're putting in a secular peak in the stock market this cycle. From here, it's all, it doesn't, and that's why I have to explain that doesn't mean the opportunities are stop here. You can have cyclical bull markets within a secular bear market, and certainly in the commodity area, both precious metals as well as copper and steel and tin and zinc and everything else in the commodity area, and including energy, because I'm calling for $500 oil by the early 2030s. You could see $50 natural gas by then. So the commodity area is going to have much, much, much higher highs next cycle. But indexes like the S&P and the NASDAQ and the Dow are not going to even get back to these levels. They'll have a bull market within a secular bear market.
I don't know if it's appropriate, but I'm going to get my media pick in early because it relates, I think, thematically to what David's talking about. And it's a film called The House of Dynamite, which has just come out, I think, on Netflix. We were watching it last night. And the premise is essentially, and I'll try not to give too many spoilers because I know I have a habit of providing far too many spoilers. So the premise is that the start of the film, NORAD or whatever the US defense system is, has they flag up an incoming nuclear missile heading towards the continental United States, and then the whole rest of the film is basically how the US responds to that throughout the various arms of government. And suffice to say, it's akin to the quote about everyone has a plan until they get punched in the face. So you can have decades of planning for this eventuality, and then when it actually comes, nobody sees it coming, and nobody knows what the hell to do.
Yep. Yeah, that's what they always talk about. Is in war, nothing goes the way you planned it, so you have to have the flexibility to adjust. And obviously, in something like this, it's pretty dire.
No plan survives first contact with the enemy.
Yep.
It's a similar similar approach to the markets, isn't it? Really, we all have a plan, and then if things change, you've got to change. I mean, it's like I know you came under a lot of criticism for talking about the melt up and gold and silver before things had happened, and people would dismiss it and said, "Oh yeah, he's been saying that for a while." And then when it comes, it's like, well, sticking with that strategy and being able to, have the conviction of your views is what makes your calls so outstanding. But when it comes to making targets, like I think a lot of people forget that these are levels that you're looking at right now, and if things change, if you have if you have more information or new information, or something comes along, you will change your view, you will adjust to it, you will and that's the only way you can deal with the markets.
Well, as John Maynard Keynes said, um, when things change, I adjust my forecast. What do you do, dear sir?
Yeah.
It is silly on X to constantly hear that somehow adjusting a target upward and extending my forecast as the cycle tells me I need to is somehow doing things badly.
Yeah, it's yeah, that I guess, I mean, it's very admirable that you're so generous with your calls on X, and you engage with so many people in the way that you do. I don't know if they realize how lucky they are to have somebody who's willing just to put in the time and effort to kind of respond, to constantly give your honest views about where things are going, to take criticism where you shouldn't really be criticized. I don't think, because this is a really hard game, and to get it as right as you have is really is exceptional. And more people should be saying that, rather than looking at things that don't go exactly to plan, because that's not how it works.
Right. Yeah, no, I'm frustrated because this truly, I've done this for 52 years. I've never had I mean, I've made a lot of good calls, but this one was harder than any. And I went against a lot of conventional wisdom, because I'm talking on the one hand about a bust coming, and yet I'm talking about the biggest bull market in history at the same time in the same forecast, and I'm different things. As you say, I'm calling for oil to go down while I'm looking for most commodities to go up. And people have no idea how. And I'm not patting myself on the back as much as if it weren't my forecast, I'd be talking about somebody else that did this. Just an unbelievable call, and yet people will pick some little thing like, yeah, but you've been saying this for 3 years. I go, yeah, because these things don't happen in 2 days. It takes a while, and if it extends, I extend. And I could have easily, they don't realize I could have easily at any of those points turned bearish because there were signs that everybody else did, and I stayed with conviction to the bullish side, not as a guess, but as that was what my work was suggesting.
I have a friend who's a multimillionaire property investor, and just to give you an example of how something like this plays out, in 2000, he invested a lot of property around the 80s, 90s, and into 2000. 2003, he said, I can't make money out of the property market anymore because it's too high, right? 2003 to 2004, this is a guy who could squeeze every last cent out of a property, and thought that it was that the boom was over. Now it went from 2003, 2004, 2005, 2006. The crash came in 2007. So he was ultimately right. But if you're looking for absolute precision on these long-term major calls, you're just not going to get them. People have to understand that.
Yep.
You're talking about a cycle. I think you mentioned it's from the way you look at it, started around the 80s, the beginning of the 80s.
1982. Yep.
1982. So we're talking about a long-term cycle that within a few years, if you get it right, that is bloody good enough. And all you can do at that point is just keep looking at the horizon and seeing what's coming. And if it's the big one, it's the big one. Otherwise, it's you stay the course. So, hats off. You've made some amazing calls. You should really get a lot of credit. Out of interest, do you have any companies that kind of try to get you back into investing money for them, or writing research directly back there? Because
surprisingly, no. I mean, I truly am retired from all of that years ago. But you would think, because I don't think anybody's even close to my forecasts
The
and my forecasting record.
The prophet is not respected in his homeland.
Yeah, and it's also interesting. Probably one of my frustrations is that, as I said, my terms get used a lot. The melt up and bust were clearly not used at all before, I became kind of known on X. And I see institutions now that adopt my forecast without crediting. I
Mm.
don't expect them to say this is David Hunter's forecast, but they could at least give some credit to, I'm agreeing with, and they don't do any of, they pretend that they came up with this. And my forecast is unique enough. I mean, there's a lot of shysters on X to pretend to be experts. They're just retail people that learned how to copy or learned how to read a chart or something, but they're not true professionals. But I'm talking about even professionals on Wall Street who
Mm.
are adopting some of my forecasts without, at all
Yeah.
giving any credit to where it comes, pretending that they came up with it themselves. And again, my forecast is so far out away from the mainstream and so different that's easy to know where it came from.
I think I came across a book earlier referenced on X, and it was a book that a guy had written about how AI was going to impact the job market. And then somebody used AI to provide a synopsis of that book.
Yeah, I don't see a lot of this stuff, but I had somebody tell me the other day that somebody's taking pieces of various interviews I've done, not just one, but various ones, putting it together and putting it out as if it's a unique on their podcast, as if it's part of something they did.
Wow.
It just, I think AI is problematic in a lot of ways going forward. It doesn't affect me. I'm not, but somebody says, "Can't you go after him?" I said, "No, I don't. I don't think any of that's being allowed as fair game."
I think R2D2 and C3PO are cruising for a bruising.
Yeah,
Yeah. I mean, if you were to stop, if you stop putting stuff out, and then that would really check the whole market, wouldn't it? They'd be like, oh my god. I know you went away for a little break to Florida, I think, on X, and it was like people were kind of melting down about where are you, sort of thing.
yeah. I left Friday and came back Tuesday night, and obviously we had a little sell off in the market. The SP is down 2% while I'm gone, and you would think the sky was falling.
Yeah. Yeah, yeah, absolutely. I just want to ask a couple of final questions, and I know you're very busy, but I'm just intrigued by one element of when you look at the markets that are going up for a long time, and so we're talking about the markets continuing to go up, yet you've said that underlying you think. Or you're saying that the economy's not doing very well, and I would think that would apply to Europe, the US, and also to China as well, which is having a boom in its stock, well, not boom, but the stock market is going up quite aggressively. What is it that what is it you're seeing, unless this is secret source and you don't want to share it, but I'm just intrigued in what you're looking at that's telling you that things are slowing down, because if the GDP numbers were stronger than expected, if the stock market, which is normally a forward-looking indicator of earnings, is going higher, how are you also seeing that deflation is coming, or and that the Fed needs to cut rates?
Yeah, so what we have in this country, it's probably a little bit different over there, but we definitely have a have and have not economy. So, and it's a big chunk. Over 50% of the economy is what I call have not. These are people that are living paycheck to paycheck, barely getting enough, barely having enough to basically afford the necessities. Meanwhile, you got, obviously home prices are starting to roll over now, but just beginning, and they've gone through the roof over the last many years. So you've got people who have been in homes for a long time, have tremendous home equity, so some wealth there. The stock market's at all-time highs, and has gone up tremendously in the last several years, as we've talked about. So there's tremendous wealth there. So you've got to have economy, and then you've got people at the top end, the top 10% making a lot of money in their whatever they're doing. So you have a part of the economy that's got so much wealth that they're spending it as if everything's fine. But then you got over half the economy that's barely getting by, and certainly and unfortunately, you've got a big chunk of the economy that's living off the government. Yeah, as you're seeing with the shutdown, people are panicking because the food assistance program is doesn't have money, and they're other programs that the government provides is not there. So it is really, and I think in socialist Europe and UK, it's probably more so than here even. But so you've got that. I say the pandemic created a lot of fragility under the surface that is still there. It gets masked by all the good stuff that's happened, all the money that's created. The bigger companies to have tremendous earnings and do well, and AI and all that. But that's masking underneath the surface the small businesses in our country. Are again, a lot of them are struggling and may not make it through a bust. Um, so you've got statistically what looks like a sound economy. 3.8 is pretty much considered a good economy. And yet, if you look below the statistics, there's a lot of trouble ahead. And frankly, housing, I think, can drop 30 or 40% in the bust, and that will expose a lot more. As I forget the saying, but when the tide goes out, it's the
You see
stuff
who's
starts
really
showing
rich.
up underneath the surface.
Yeah,
There's never any one cockroach in the kitchen.
yeah,
Right, that too. Yep.
yeah,
Um,
yeah,
so that's I think, and also having 2008-9 was an eye opener in terms of how fast we went from things looking okay
Mm.
to real trouble.
Yeah.
As I point out, in September, I was a strategist on the street. In September, I was among the very few, and I don't remember who else was, if there were other, basically saying hard landing ahead, directly ahead. And the vast majority of Wall Street economists and strategists were saying soft landing, no recession in sight. This is September 2008, literally
Yeah.
weeks away from Lehman Brothers
Yeah. Yeah.
and the disaster that followed that in the next few weeks. So that's how fast the unwind can come. And I think this bust is exactly that same kind of thing, where you can go from, topping out in the market, everything, people having enough news out there to keep them sanguine and happy, to, weeks later, disaster. So people ask me, to predict, when do you think the bust hits? I said, well, keep in mind, the bust is a morphing of the recession. A recession starts, and then somewhere along the line, it morphs into something much worse as you start seeing banks fail and things. I can't time a bust. The bust is something that comes out of nowhere. It just hits. I can time the recession, or try to time a recession, and we may be in recession already in spite of that GDP number. Or if when they go back and backdate it, the National Bureau of Economic Research in this country doesn't time the recession till after it's over. They'll
Yeah.
go back and say it started whenever. And
Exactly.
through my career, it's always started before you thought it started. So
Yeah.
we could be in it now, for all I know. And yet, I think certainly it's going to start showing more signs of it as we move into 2026.
Well,
I think it was Russell Napier that said, it's a recession when Citigroup files for bankruptcy again.
Yeah, I mean that's more that's what I call bust. Recession is before that. That's another thing I see in terms of what causes me to say, things aren't great out there. You are seeing the deterioration in credit. We have subprime auto is a problem this cycle. There's a lot of people, because they can't afford a car with a 4-year car loan. Now they're extending car loans out to 8 or 9 years. And there are people who are, a year into their car loan, or even 6 months, that can't afford the car loan that they signed up for, even though it was, stretched out to that many years. You've got, home deterioration, home credit deterioration is beginning to show. So there's a lot of things, and we obviously just saw the private credit issues. And even though they're attributed to one or two fraudulent things, I think it is a sign that the strains are starting to show up. And that's always what you see before the recognition of a recession, is the credit deterioration, and then it accelerates from there.
I just wanted to endorse what you were saying about the last crisis and how it played out, because I was working for an investment bank as an analyst, and the economists didn't see what was coming. In They were looking at non-farm payrolls and saying, "Oh, the economy's okay because of non-farm payrolls." And prior to that, you saw the banking stocks had started the property stocks went down in around 2005, and the banking stocks were already turning and going lower. Then in 2007, you got short-term interest rate futures, which were showing that there was stress in the banking system. Credit default swaps were blowing out, and they were just ignoring all of this information. And and then as the cracks were appearing, the Fed were doing more to stem them, and it was like, oh, we've done this package and it should be okay now. And honestly, it was incredible to watch. It was complete disbelief that anything bad could happen.
Well, Ben Bernanke was denying there was a recession while the recession was already in place.
And what was hilarious was that and I'm so glad that you've reminded me of the department that tells you when the economy's in recession. And it was like, once the recovery had started, they then said, oh yeah, the recession started in like whatever it was, 2007. And you're just going, how are they not changing how they look at the markets?
Why do they still have a job?
Keep in mind that the NBER is, I don't know who it is over in your neck of the woods that does it, but the NBER, it's the official starting date is what they do after the fact. There's plenty of economists that obviously are forecasting recession once you're in it, but the NBER, they can't really. They have to get all the data in and stuff and then they may tell you when they thought it would start, but the official date is not really able to be calculated till after the fact. But it always, as I said, it always seems to be that it starts before you ever thought it did.
But it presupposes the data itself can be trusted, which it can't.
But
you cite a 3.8% GDP print, but I wouldn't trust that. I wouldn't trust it as far as I could throw it.
Oh yeah, the current numbers are, who knows? I'm not that. That's a different story. Yeah, we have GDP now, which is the Atlanta Fed's effort to kind of predict ahead of time, and that thing can start out the quarter very strong, and by the end of the quarter be very weak. So, the numbers move around and all of that. I certainly don't invest by monthly data.
Yeah, the point I was going to make is that if all the authorities who are making these decisions that are so important to the economies and everything else, if they haven't got the data, if they can't see what's happening, if they don't have the ability, which we know that anyway, but we know ultimately they can't do it. We know that they always get it wrong, or ultimately they get it wrong more often than they get it right. And if the people who are their sole job is to predict when the recession starts, and they can't do it even with the best technology, the best data and all of that after it's happened, it's exactly why we're just going to keep seeing this boom and bust repeat, which is, funnily enough, Gordon Brown, who was the Chancellor of the Exchequer and who became Prime Minister, said that he'd ended boom and bust at the time.
Sold all our gold at the low.
Sold all our gold in the early 2000s, bought euros. It's just incredible, really.
Well, keep in mind, the Federal Reserve is determining policy, and I think it's much more about the Fed and central banks than it is anything else.
Yeah.
The Federal Reserve is using as one of their two mandates a lagging indicator to determine policy. So if jobs, if unemployment jobs is one of your two mandates, and you're keeping policy tight because so far jobs look okay, jobs are a lagging indicator, and you're being asked, and there are 6 to 9 month and maybe 12-month lags to when your policy impacts the economy. So you're talking about 12 to 18-month lags or more sometimes to, you're looking backwards to determine something where even if you enact today, it's not going to have the kind of impact that you're hoping for another 6 or 9 months. You got that period of time in there that can be as much as a year where you're totally out of sync with what you need to be doing. And so it's silly to be using. I mean, I don't. Wall Street gets all excited every first Friday of the month for jobs, right?
Right.
And CNBC puts on a bunch of economists to predict that before the number comes
Pre-game
out. And
show.
Wall Street sells off if it's a disappointing number or whatever. I have never used jobs in any of my work when I was running money, nor as a forecaster. Monthly jobs do not mean a lot to me because it is a lagging indicator.
It's almost as if central planning doesn't work. So thank God we allow the price of the most important thing in the world, namely money, to be directed by central planning.
Yeah, exactly. Central planning. Again, our central bankers, they're all, people want to attribute politics to it, and I go, no, it's a committee. It's a committee of academic economists mostly, and Jay Powell's not even an economist; he's a financier. Sitting down in a committee and by consensus trying to determine policy. I can't think of a worse way to do it, except that it kind of is steady as she goes. We're not going to make dramatic changes very often. So maybe that's a positive when you don't have confidence in what they're doing. But again, they have integrity. They're good people. They're not. I don't think they're playing politics generally. It's more about the process. It's even they, as much as it's a big part of what they do, or what influences what they do. Even they and even Jay Powell do not really grasp leads and lags the way they should.
I just want to ask one final question, and it relates to the Pareto principle of 80-20 in nature. And I think wealth was distributed 80-20 at some point, and then it's become concentrated into the more and more wealthy and then super wealthy. And I always wondered if perhaps this is the purpose of these big crashes, to reset that, and whether when the bus does hit, it should, in theory, hit. It's going to hit everybody, of course, but it should hit the super wealthy the most. And I wondered, do you think that's a way of resetting the Pareto principle back to perhaps where it should be, or is this just an idea that should be dismissed?
Yeah, I come from a different place. My thing is we are this bust is the worst thing we've had in 90 years, let's say. I get there because every successive cycle, starting with the early 40s, coming out of the Great Depression, every cycle you had, what our cycles are is we run to excesses, inflation builds up. The central bank has to lean against that and tighten down the hatches and try to ratchet down inflation. Each successive cycle, you've had more highs and more low. It takes, the excesses on the upside get greater, so it takes a bigger tightening. So the excesses on the downside. So they overshoot on the upside and the downside. So each successive cycle, somebody told me it's like a buggy whip. Each successive cycle gets more violent or bigger. And we're now 80, 90 years away from it. It's what I call, we're in the last decade of a super cycle, which I define as a cycle between the long cycle between two depressions. In this case, it's the 1930s, and what I think will be the mid 2030s will be the start of the next one. So almost 100-year cycle. And as you get that far removed from the last depression, you've gone to where now, you got, as we saw in 2008, the excesses on the upside, and then the excesses you get excesses in terms of leverage, in terms of inflation, and then you get the excesses because they go too far on the downside, and then it takes even more money to pull you out of that downside because you're free falling. And I think that's why I call this the bust. Is it's bigger than 2008 in terms of what it'll take to pull us out of it, in terms of how fast we're free falling, the financial system is free falling, and how much money is going to take to get us out of it. And that gives us one last hurrah on the upside, but it's one last hurrah that comes with hyperinflation. And then there's no the next time around, they don't have the printing press to pull us out of it. So then you collapse and go into another Great Depression. So I think it's more the farther removed from the last depression, it takes many cycles to build to that extreme that leads to a collapse. And this collapse, because leverage is far beyond anything we've seen in history, I think this collapse is, the bust is not the collapse. The bust is the precursor of the collapse, but it is going to lead to what leads to the collapse is that all that money, because it drives us to that inflationary high, and then, without any ability to pull us out of that.
Tim, was there any final questions that you wanted to ask?
No, all I'd say is on a positive note, it is nearly Christmas, so there is that to look forward to.
Well, I will say, the next few months could be the biggest Wall Street rally in history. I mean, I think we're going to go vertical, and it's going to be in a lot of things. It's going to be in the metals. It's going to be in the stock market. It's going to be in technology. It's going to be, even the Russell is going to be doing very well. So I think the next few months, it's going to feel like all is well and everything's going great. And I think you're going to see the roaring 20s type of a personality out there. We're not there yet. But I think if this thing gears up here I think this most recent 2% pullback in the S&P and 5% in the semiconductors, et cetera. I think it was kind of the last kind of cleansing before, building that wall of worry for that last run. So I might be wrong. Maybe it stretches even further. But my guess is we're looking at from basically early November to February as kind of the sweet spot for a final run. And then it's, hold on to your hats because you're going down.
Dave, thank you so much for coming on the pod. Just to remind everybody that your handle is Dave H. Contrarian.
It's at Dave H. Contrarian
on X. And so the name Hunter isn't in there, but Dave Hunter is your name. Look out for fake accounts. You've got over 220,000 followers. And what happened after, I get a few that pretend to be you and I just report them. So if anybody gets anybody pretending to be Dave Hunter, please just report it to X and they'll delete the account.
Yeah, I would very much appreciate that, because there are people that will use that at Dave H and change one letter in there or whatever. And there are other people that will use my profile picture. Their handle won't be matching mine, but you just have to look out there. And if you see any of those people, they're trying to scam you, so report them.
Yeah, I've done that many times. They've worked out that I will report them, so they don't do that anymore. But I want everybody to do that, please. And also, just to say, for people who are watching this, you have to appreciate the level of skill and the outstanding calls that Dave's making. And I'd appreciate it if you go to his Twitter and just put in how much you appreciate the work that he's done, because, he is retired. He doesn't have to do this. He's trying to help people. And it's a very difficult game. I've been in it over 30 years, as has Tim. He's been in it for 50 years. There's a lot of people that are just trying to make money in the short term, but you've got to realize that people out there are just doing this because they're trying to be professional. They're trying to help other people, and they don't need to do that. They're not necessarily getting very much for it. So, it would go a long way if you can put some nice comments in his, not on this video, but in his X account. And also just to remind people that you do provide a quarterly letter. And if you want details of that, they should DM you, and it is a paid for letter. It's not free.
Right.
But you need to DM you for the details of that, if I'm hearing that correctly.
Yep. Yeah, I have people saying I'm a shyster because I'm on here selling my newsletter. I don't even mention it on X hardly at all unless people ask, and I make them DM me because I don't want to be pumping it on X. I put a lot out there for free. Yeah. I came on to Twitter back in 2013 after I retired with the idea, I love what I do and I think I do it well. with the idea of helping the little guy who, because I do have an alternative view to what you get on CNBC or basically across Wall Street, to help people learn how to preserve their capital, how to make money instead of, because, people don't realize you follow so-called experts and for a little while you might feel good, but all of a sudden that stuff didn't work out and, your portfolio is not what you thought it would be. I'm trying to teach people that psychology does play a big role in this. And if you can kind of get away from the crowd views or know when to go with the crowd instead of always going with them, that you can do better. My whole purpose on being on there is to try to teach and help give people kind of a little better sense of finance.
Well, thank you for doing that, Dave. Really appreciate it. And thank you so much for coming on and giving up so much of your time. And we really look forward to having you back when you've got time to come back on.
Sure. We can recap maybe and see how right or wrong I was.
Thank you so much.
Okay. Thanks, Paul. Thanks, Tim.
Thanks, David.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.